Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. GST Council levies 28% tax on online gaming, recommends casino, horse racing to be taxed at the uniform rate of 28% on full value. Industry reacts sharply, calls it a killer blow which could wipe out the e-gaming industry. Online gaming stocks plunge in today's trade. Owning a large utility vehicle, an SUV or an MPV could get expensive as GST Council has raised the cess on utility vehicles from 20 to 22%. GST Council has, however, reduced the tax on food and beverages sold at multiplexes, which will now attract a GST of 5% instead of 18%. A sharp fall in the last hour dragged Nifty below 19,400. Sensex Nifty settled lower after 3 days of rally. IT shares were top laggards ahead of Q1 earnings. The country's largest software exporter, TCS, reported a 16.83% jump in its June quarter. Net profit at 11,074 crores. However, records slowest June quarter growth in a decade, excluding the COVID period. HCL Tech's Q1 profit dips over 11%, pays 10 rupee dividend per share. India's retail inflation surged to 4.81% in June after hitting a 25-month low of 4.25% in May. India's industrial production growth rose to 5.2% in May, up from 4.2% in April. In what could provide a relief to consumers from sky-high tomato prices, the Department of Consumer Affairs has directed to procure of tomatoes from Andhra Pradesh, Karnataka and Maharashtra for distribution in Delhi NCR at discounted prices. A day after the GST Council bowled a tax googly at India's online gaming industry, the move has led to fears that this will be a killer blow for the sector. Here's why online gaming, an industry estimated to be about 25,000 crore rupees, has been sent back to the pavilion by an umpire in a repeat of how the crypto sector was taxed into oblivion 2 years ago. Listen in to what the Finance Minister has said on the decisions taken.
Online gaming, horse racing and casinos will be taxed. They will be taxed at 28%, each one. And they will be taxed on full face value. The discussion also looked at what is skill-based and what is chance-based. Whatever be the decision on each of the game being either skill or chance-based, or being both or being neither, is not what we are looking at. We are purely looking at that which is being taxed, because it creates value, profit is being made, or a wager is being levied. Based on the wager, people earn windfall, which is what is betting all about. So that's what we've been talking about, and therefore today's decision looks at that aspect of what is to be taxed at what rate.
The online gaming industry had been waiting for the final decision of the GST Council with bated breath. And on Tuesday, the centre state body of the finance ministers dealt the sector a killer blow. Not only was the rate of GST increased to 28%, the tax will now be levied on the full value, the entire bet amount in the game. Moreover, the GST Council has removed the distinction between game of skill and game of chance. The enhanced levy comes on top of the 30% tax deducted at source that is already applicable to the sector. In effect, the sector will now be taxed at over 50%. Experts see this as a massive setback for the industry. The government disagrees. Union Finance Minister Nirmala Sitharaman said the decision to levy maximum tax on online gaming in casinos was not intended to kill the industry, but was considering the moral question that it cannot be taxed at par with essential commodities. Explaining the rationale, Sitharaman said it was impractical to meet the industry demand for levy of tax on platform fees.
So it is impossible to pierce that veil of, veil which brings opacity on how actually it is operated. And then say, no, I know what happens inside, therefore I'll only go by that. I'll go following every fellow, every tourist, and say, are you playing at this table? Are you paying at that table? How much pay you pay? Impossible to execute. So the discussion went thoroughly.
The reactions are coming in fast and furious. A day after the announcement, Ashnil Grover, the ousted co-founder of Bharat Pay and former Shark Tank India judge, tweeted, "India is super fun, super ironic. Uncles sipping on their drinks, smoke in hand, bragging about how they made their fortunes in land speculation by putting their cash to good use, planning their next casino trip to Macau and passing judgment on online gaming and how it's spoiling the youth. Would love to see government introduce 28% GST and 20% TCS on land purchases." Bureau Report, Business Today TV.
Stocks of listed companies in online gaming saw a sharp knee-jerk reaction in today's trade. BTTV's managing editor Siddharth Zarabi spoke to Nitish Mittersen, Joint MD Nazara Tech, and Roland Landers, CEO All India Gaming Federation, to find out what could be the ramifications on the entire industry if the GST levy is implemented.
There is a moral question involved in this. Online gaming cannot be treated at the same level as essential commodities when it comes to taxation. Your first thoughts on this?
Yeah, thanks, Siddharth. So, I just wanted to lay the facts here so that you and your viewers can get a sense of, the impact. The thing is that from the moment, so we have to look at the ecosystem, which is made up of the game developers, the gaming platforms, and then the gamers themselves, the consumers, right? So if you look at the impact on the gaming companies or the platforms, then moving from the methodology of valuation from GGR to the face value, as has been highlighted in the press con yesterday, that is going to be a 1100% impact. Coming to the gamer, for him or her, the participation in a game is going to get more expensive by 300%, or 3 times more expensive. And for the gaming platform, coming back to the platforms, the revenue, the valuation methodology of face value will get more, the percentage of tax, indirect tax, will be more than the revenue of the platform. And so that would be the impact. Just wanted to give you a sense of the impact across the gamer and the gaming platform community.
Okay, from your answers, it clearly means that the sector has been dealt a death blow. Do you see it even surviving with the kind of numbers that you have just shared with us?
No, I do not know of any precedent of any other industry or sector that could, that could buffer in or factor in such a impact, such a high impact. Moving from gross gaming revenue methodology, and the rate from 18% to 28 is fine, which is about 50 odd, percent. Can be factored into, but 1100% I think is, I do not know. I mean, if you are aware of any precedent for any other industry also, there does not seem to be any. So that I think, but at the same time, we are hopeful. Now what will happen is, inadvertently, the gamer would, veer towards, that is not the intent, but inadvertently they will veer towards platforms that that do not pay GST taxation.
Tell us your first thoughts about this decision to levy a 28% GST, and that too on the entire full value or the bet amount or entry value as it is called for online gaming. Nitish.
Yeah.
Sure. So this particular decision of the GST is in relation to the real money skill-based gaming, which has become very popular in our country and is the largest revenue driver in online gaming in India. And I think in this, this significant increase in tax or GST has some impact, or I would say significant impact on the business viability of this particular model. In my own company, Nazara, we have limited exposure of only 5% to this particular segment, so there's a minimal impact to us. But if you were to ask me from a skill-based real money gaming industry per se, there would be a much larger impact.
Okay. Let's break it down for our viewers to understand. First, earlier the taxation was at 18% on the platform fee. Now it is 28%, but on the entire bid amount. Also, the distinction between games of chance and games of skills has been done away with. Can you help sort of give us an example of, using, let's say, 100 rupees as the full value and explain what was earlier and what is going to happen now?
Sure. So in the first case, when a consumer or a player would put in 100 rupees in a game, the platform would earn a 10% commission on it. So they would earn 10 rupees and a 18% GST would be paid on top of that. So let's say approximately 1.8 rupees. Now, in the new regime, on 100 rupees, you would have a GST charge of 28 rupees. So really speaking, the 1.8 becomes 28, which as you can see is really a significant jump in the taxation. And what this is going to do is, the amount of winning that the consumer could win back would significantly decrease. And therefore, the incentive to play or participate in such games may reduce. We of course will see what happens once it is implemented, but that is what the expectation is.
Along with online gaming, the GST Council made the decision to include all utility vehicles in the 22% cess category, which marks a 2% increase and eliminates the previous varying rate of compensation cess. As a result of the elimination, sport utility vehicles and multipurpose vehicles will now be subject to the new tax bracket. Business Today TV's Chetan Bhutani spoke with Maruti Suzuki's Shashank Srivastava on the impact of the cess and whether this decision could lead to higher prices.
Please clarify the news on the tax incidence on MUVs, which has been increased from 20% to 22%. Has the definition only been changed, or will the consumers have to eventually pay out a 2% extra?
First of all, let me give a caveat first before I explain in detail. The notification hasn't come yet, so we have to see the details of the notification to have a definitive view. However, based on the reports which we have got from the GST Council committee, it seems that there will be some more UVs, the utility vehicles, which will see an increase of 2% of cess. So for your viewers, for clarification, let me say that for clarity and also simplicity, there is a base GST rate of 28%, and over and above there is a cess. The cess is either 20 or it is 22%. So the question which is coming since yesterday is, which vehicles will attract 22% and which will attract 20%. So far, the vehicles which were attracting 22% were to meet 4 conditions. One, they should, as the provisions were, one, they should generally be known as SUV. Second, the length should be more than 4 meters. Third, the engine size should be more than 1.5 liter. And fourth, the ground clearance should be more than 170 mm. These were the 4 conditions. Now, this led to a lot of confusion because what is meant by generally known as SUV was not clear. And as a result, yesterday, the GST Council removed this condition. In other words, even vehicles which are generally not known as SUVs would also come under this category of extra cess, which is 22%. And that means some of the MPVs which were earlier not being seen as coming under 22% cess will come under it. That's one part. The other conditions remain the same, which is 4 meter, 1.5 more than 1.5 liter engine, and a 170 millimeter ground clearance. As far as Maruti Suzuki is concerned, there seems to be no impact because the first condition itself, in Maruti Suzuki portfolio, there is no vehicle more than 1.5 liter in engine size. So all conditions are therefore become irrelevant, except that last week we introduced the Invicto, which has a 2 liter engine. But then that is a hybrid vehicle. We have a hybrid version alone, and hybrid vehicles do not attract this higher duty. So Maruti Suzuki vehicles will not be affected. Of course, as I said, we need to study the notification in detail, but this is what it affects.
Ertiga XL6, your prime MPVs have no impact, and the Invicto just being launched will also not be impacted. And what about Grand Vitara, sir? Also the same with the
same. Because the engine size is less than 1.5, so it doesn't attract.
All right, sir. So otherwise, for the overall perspective, sir, for the companies who are actually your rivals, I'll speak to them on a differential basis, yes, but these SUVs also will will eventually see a hike of 2%?
Yes, so some of them are already in that bracket of 22%. However, as I said, there are some SUVs and MPVs. Now, of course, MPVs have now come into the ambit of this extra cess. They were earlier not there. But even under SUVs where the ground clearance was more than 170 mm in unladen condition, they were already paying that higher duty.
India's consumer price index CPI inflation rises for the first time in 5 months to 4.81% in June on the back of a jump in vegetable prices. Also, the rise in inflation is higher than the street's expectations. India's industrial production, however, picked up 5.2% in May against 19.7% a year ago. Markets remained volatile for yet another session and ended lower. The Sensex was down 223 points at 65,393 and the Nifty was down 0.3% to close just below 19,400. Broader markets continue to outperform. The Nifty Bank fell sharply from the day's highs to end 100 points lower, and Delta Corp crashed 23% post GST hike announcement on casinos, eroding over 1,500 crore in market cap. Top Nifty gainers today: ONGC, Eicher Motors, Nestle, Kotak Mahindra Bank, SBI Life. Laggards in the session: Adani Enterprise, Tata Motors, Ultratech Cement, Infosys and Adani Ports. Kickstarting earnings season for the April to June quarter, TCS, the largest IT firm in terms of sales, reported a 16.8% year-on-year rise in net profit at 11,074 crore rupees for Q1, largely in line with analyst estimates. Revenue for the quarter came in at 59,381 crore rupees, up 12.5%. Revenue growth in constant currency terms grew 7% year-on-year. The IT giant has also declared an interim dividend of 9 rupees per share and gone ahead with a salary hike to take 200 bips hit on its operating margin. Listen in to what the management had to say going forward.
Moving on to segmental commentary. UK bucked the trend of global demand softness and grew by 16.1%. North America and Europe grew by 4.6% and 3.4%. Our growth markets like India, LATAM and Middle East and Africa all had a strong double-digit growth. Among the verticals, life sciences and healthcare, manufacturing and regional markets and platforms had a strong growth. Life sciences and healthcare grew by 10.1% and manufacturing by 9.4%. Regional markets and platform grew by 16.9%. Among other verticals, BFSI grew by 3%, retail and CPG grew by 5.3%, technology and services grew by 4.4%, and communications and media by 0.5%. Our deal wins continue to be very strong, supporting our belief that investments in technology will remain strong over a long period of time. Our order book closed at 10.2 billion this quarter, marginally higher than last quarter, and almost 24% higher than same period last year. We had deal closures worth 5.2 billion in North America, 3 billion in BFSI, both North America and BFSI being 15% higher than Q1 of last year, and 1.2 billion in retail and CPG. Our attrition continues to improve. On a LTM basis, our IT attrition has reduced to 17.8% from 20.1 in Q4.
We are going to basically pay, 100% of variable pay for 70% of the people, our people, and the rest 30% will get paid based on the business unit performance. Regarding your question on onboarding delay, for many years we always honor all the offers, and that would continue. There are certain delays based because of the environment we are in, because of the project delays. Kriti just talked about release 1, release 2, and how things are not getting progressed. As a result of that, the onboarding of those associates also gets delayed. So in certain cases that is getting delayed, yes, but that is purely based on the project situation. But I commit to today that we are going to honor all the offers.
HCL Tech also reported Q1 earnings, where it recorded a net profit of 3,534 crore rupees. Repeat revenue at 26,296 crore. Earnings before interest and tax margin came in below expectations at 16.9%. However, the company declared a dividend of 10 rupees a share.
In terms of an operating parameters, our EBIT came in at 17%. This is at the same level as our Q1 last year, which was also at 17%. On a sequential basis, it has declined from 18.1% to 17% this quarter. In terms of bookings, as you're all aware, our bookings for the previous 7 quarters have been in the range of 2 billion and above. This quarter our booking was at $1.6 billion. It's been a little softer. However, I'm very happy to report that our pipeline continues to grow. Last quarter we did report that our pipeline has grown significantly. It has further grown in a strong way even in this quarter. And we are very optimistic about the pipeline conversion and its revenue translation. That will help us meet the full year guidance which we have given. Our headcount also declined last quarter by about 2,500 people, primarily due to the fact that we have consciously not backfilled some of our attrition. Double clicking on our quarterly performance by service line, our IT and business services had a good momentum on the new deals signed. A lot of new deals signed, ramped up quite smartly, but most of the gains were offset with the reduction in discretionary spend in a couple of verticals. This has resulted in our ITBS segment being flat in constant currency terms.
That's where we leave it on the show tonight. Thanks so much for watching.